Hey guys, Jeff with optionboxer.com. It's been a while since my last video, so I'm excited to get back into making videos. Those of you that have watched this channel before or kept up with my videos, you know that I'm a coach and a teacher. So been in football season right now. I've been very busy, so I just haven't been able to make as many videos as I normally would, or any blog posts for that matter. But regardless, I'm excited to be back, and I do have some really good news for you. Jesus is still on his throne. Those of you that know me know I'm a man of faith, and so I'm excited about that, number one. And then number two, the market just seems to be collapsing, and I know a lot of our accounts are not doing well. I know mine's not doing well at the moment. But this video is going to be pretty exciting because I'm going to show you how to take a small account and turn it into a windfall of cash. So stay with me till the end, and then let me know what you think in the comments. But before we do that, please know that I'm not a registered financial advisor, and this video is not a recommendation for you to buy or sell any security or place any options trade or any trade. Just make sure you're doing your own research prior to trading. With that out of the way, let's go ahead and take a look. So I've got Dow pulled up. I found a stock that I like that has been trading lower with the overall market. Obviously, pays a reasonable dividend. Generally raises their dividend. Let's take a look back over the last 5 years just to kind of see. Looks like they've kept their dividend stable over the last 5 years. Maybe we can see longer term. Looks like for as far back as it goes, it looks like they've maintained their dividend. So not ideal. I would love a candidate that would be a dividend grower, but I've got it on the screen and I've already kind of determined I was going to use this for the video, so we'll take a look at it. I created this spreadsheet that we're going to look at together today, kind of quickly and just kind of on the fly. But I think when I'm done with this, you're going to say, wow, I didn't realize how easy this was, or how I didn't realize this was even possible. So I'm going to run you through what the spreadsheet does, and we'll kind of look at this together a little bit. But I've got 10 years mapped out just from this year till 2032. Really, it's 9 years and a couple of months because we're already in October. This year's went by really, really quickly. But let's say you bought 100 shares of Dow at the current price of $44.41. That would be a total account size if you just own this one stock. And I know everybody that you've probably ever talked to or ever seen says don't put all your eggs in one basket. But I'm going to challenge that thought process today. Or even if you don't want to put all your eggs in one basket, if you have a larger account than $4,000, if you had 10, 20, 30, 40,000 or whatever you wanted to invest, and you could do this with a number of companies, and then of course you would be diversified that way. But if you get to looking at this, you see that just comes out to an account value of $4,441, and you started with 100 shares. The dividend amount each year, this is all kind of on a yearly basis. You can see I just kind of went ahead and did the math for you. It pays 70 cents per quarter, so I just times that by 4 to give you $2.80 per share per year. And so every year, just by holding this 100 shares, you're going to get $280. Now, options is really where the power of this kind of strategy comes into play. And so you have to make some pretty big assumptions. And I know right now, if we take a look here at the options market, I know right now volatility is elevated, and it looks like it'll probably stay elevated for a while. But that's not always the case. So you would just take a look at this, and let's say you did the wheel strategy. This underlying strategy here is the wheel strategy. Let's say you sold a put to get into the shares, and you sold a call to just collect some income, hopefully not to lose the shares. If you did that, then that wouldn't be ideal. You would have to buy them back, or anyways, this kind of calculation doesn't assume you're going to lose the share. So again, I go back to it makes some really big assumptions. At some point, price is going to rally and you're going to lose those shares. But if you never did, or if let's say you sold far enough out of the money that the odds of you losing those shares were very, very slim, then of course this could make a little more sense. But it would require some management. I know that. I realized that at this moment, when I made this, I realized that. And so I need you to realize that it would require some management to see this through to fruition. But I want to show you how powerful it can be. And the real power in this is when the market goes down. And if the market does go down, then you don't have as much concern about losing your shares if you sold a call. But let's say we were fairly conservative. We sold somewhere around, let's say 50, which is $6 away. It looks like it's got a delta of about 18. So that's a pretty low probability that you're going to get these shares called away, at least in this market. So let's say every 42 days you were able to get $50. And again, this is another assumption. And then let's say you were conservative on where you sold your put to get into the shares. So let's say you were down here. Where's the delta at? Somewhere about the same. So about 52. Let's call it 50 just for easy math. So about $100 every 42 days. And I've already done the math there. That works out to about 8 times a year. So if theoretically, of course, making that assumption, if theoretically every 42 days you were able to get $100, that would be $800 a year that you'd be able to get. And then if you wanted to contribute anything, let's say you wanted to contribute, $50 a month, I think that works out to about $600. So there's always a little bit left over. You don't have enough to buy a complete share. So, I'm sorry, it's not taking into account fractional shares, even though the fractions are here. Otherwise, this money would be spent on those fractional shares. But regardless, if you can extrapolate this out, we are, of course, assuming a 9% return per year. Again, another assumption. This price, share price isn't going to go up consistently at 9% per year. Let's say it averaged out to 9%. Some years it went up 20%. Other years it fell down by 5-10%, whatever it may be. At the end of this, you would have only contributed a total of $11,000 over the course of 10 years, and your final value would be $60,000. So that would be a 451% return if the market rallied 9% per year. Now watch what happens when I take that down. The market value for this stock declined by 1% per year, and you still ended up with the same return. Of course, I should have said the options, it calculates based on the number of shares. So anytime you get to 200 shares, it's just automatically going to double your 100 shares of option premium per year. And then so every time you get an extra 100 shares, it just calculates based on that 100 shares. So the overall return of the share price was 1% lower each year. So you can see you bought it for $44.41, and here at the end, it's the share price is $40.16. So not what you would call a good investment. As the price went down, over the course of this 10 years. Now what happens if it goes down by 5%? Well, now you've got a 603% return. Kind of crazy how the options income starts to add up. Now what happens if the stock absolutely collapses? The numbers don't even fit on the screen. Let's see if we can get that. If the stock went down by 20% per year, obviously that's a staggering decline. There's probably something wrong with this company, and the reality is the options market would probably dry up if it went down by that much. But even 10%, it's not unreasonable to think a company could go from $40 to $15 over the course of 10 years. Assuming the options market didn't dry up, you're looking at an $11,000 investment turning into $132,000. So just shocking what's possible when you start compounding this options income and using it to buy more shares. And then, of course, it's only going to give you more dividends, which is completely risk-free money, maybe 15%. It's certainly not something that we haven't seen before. If the market, just collapsed like it did during the coronavirus or maybe during the 2008 market crash, this $11,000 turned into $370,000 based solely on the options income. Well, not solely, but mostly on the options income. Even if you had contributed nothing over that time, your investment would have been $4,441, and the final value would be $209,000. So a 4,617% return, and all you had to do was buy 100 shares of this company and then continue to reinvest the money that you had there, and just a staggering amount. Now, this 4,000. Assume you did this with 10 other companies, and you can see how in a 10-year period. You contributed nothing other than the initial value to get the 100 shares, and then the options income just kind of continued to compound itself And the more shares you bought, the more options income you made, and the lower the shares went, of course, the more shares you could buy. And then kind of the sky is the limit there. But I wanted to share this with you, just something I've been working on. It's a strategy that I do use in my own trading, and I thought many of you would find value in it. I know I'm enjoying watching the dividends come in. I know I'm enjoying getting the options income, even though my account value is currently falling, or I shouldn't say it's falling. My account value from a profit and loss standpoint is of course going down. You can see it's down by 2,900 at the moment, but it's not accounting for the options income that I've already received and that I've put back into my account, and it's not accounting for the dividends in that metric there. So overall, I am down. But you can, I'd have to do the math. I'd have to look at my personal trade log to see where I'm actually at as far as how far I'm down. You can see I had a tough day today. I lost $453. The market pretty much collapsed again. And this isn't really a video to talk about the market, but you can see the market was down really big. And of course, I lost some money today. But regardless, I think this is a really cool tool. If anybody has any interest in it, they can certainly reach out to me and I can provide this, or I can show you how I did this. But anyways, you can reach out if you need to. I just wanted to share this with you. Really, really powerful strategy, how you can turn a small amount of money, $4,000, into a whole bunch of money relatively easily and with minimal work on your part. Again, some big assumptions were made. The dividends, the only thing that you truly know, at least at this moment. The other thing that's not calculated here is if you did trade a company that continually grows their dividend, well, then your dividend would of course be getting larger faster, and then the options income of course makes the assumption that the premiums will stay where they are now, which we definitely know that they won't. But again, we were kind of further out of the money. You could always play a little closer to the vest and take the strike price closer to at the money. Make a little bit more income, but you may not get as good of a price on the put side when you decide to get the shares, or you may get the shares called away if you get too aggressive on the call side, and so just take that into consideration. But again, I've been long-winded enough. Appreciate you guys watching. Sorry for it's been so long, but for those of you that have watched this video to this point, please do consider liking or subscribing or commenting. Ask any questions you may have. Always happy to help. But that's it for this video. So if you have any questions, feel free to reach me in the comments or at jeff@optionboxer.com. Thanks for watching. Take care.